have you here. And it is with these episodes, it's my desire to allow you to understand better what the Forex market is, how to trade it, how to understand it. And then today I actually have a question from one of our viewers. In fact, I'll slide on over here. All right, so handy dandy notepad. And we're also going to tackle what we tackle every week, which is the contrast watch lists, what specific currency pairs I have on my radar, on my watch list, and then also today's question, and thank you, Sandy, for sending in the question. Sandy wanted to know what the connection was between currencies and equities. And I thought that's a really cool question because it bridges two of my favorite markets. Oh, who am I kidding? They're all my favorite markets, as long as there's an opportunity and there's liquidity. So it bridges these two markets, and there is relevance, and we'll talk about a few things about how they're connected, why they're connected, and how some of those opinions about their connections are really a little, right now, misplaced, but nonetheless pretty effective, pretty impactful, influential. All right, so if you remember from last week, and by the way, gang, I really recommend, this is not a trading per se bit of advice, but it is. I have these little notebooks I keep. My motto. Can you see that? I keep these little notebooks, and they're little flip pads, and they're just index cards, and then they're held together by these. I think they're called circa rings, but I think ARC makes them now too. I can slip this in my pocket. I can take this pretty much wherever I go. It's compact, and it holds the keys to the universe, nuclear launch codes, and yes, it holds notes as far as what I want to be doing in the market. So having them compact forces me to be very succinct about my trading ideas, distill them down to the very essence of, do I want to be long this or short this? I do like to be a whole lot more granular and write. I'm an English major, so I love to write. I will do that in a separate journal, but that will be kind of how I distill my ideas down to this, right? A lot of folks, and I believe this is true, you don't really know what you're thinking until you have to write it down. So I really recommend doing this. And I don't do this just for our shows here. This is something that never leaves my side, okay? All right. So for the last quarter, we continue to see, this is something we've talked about now for quite a few episodes. We continue to see Aussie and New Zealand dollar strength. Now, most of what I do in Forex, gang, most of what I do is on the daily time frame. Now, can you day trade Forex? Yes, but I'm going to tell you, you have to be a lot more self-directed. I'm saying that for two reasons. I'm saying that as someone who is an active trader in a chat room where we trade futures, and even then I'm not super active. But I'll also say this in terms of our Forex Mastery, our program where you get to see my analysis, my trades, the setups from soup to nuts, as they say. I'm not even sure what that even means, but it's really all-encompassing. And you can check that out, by the way, at simplertrading.com/FX. And so even in that mastery, in my own personal trading, most of what I like to do in Forex is going to be on the daily time frame. Occasionally, and I do mean very, very rarely, I mean, gosh, if I put on 100 Forex trades, maybe a dozen of them might be on the 480-minute time frame. Oh, that's better. Might be on the 480. It's an interesting proxy where it's a smaller time frame, but it should and does, in the ideal scenario, mimic what happens in the daily. So all that's to say, keep notes and focus mostly on the daily time frame. Now, why? It's going to allow you the most time to make decisions rather than looking at a 5 or 15 or 30 or 60-minute time frame. The shorter the time frame, the narrower your window to recognize, act, and take the trade, right? Get your orders in and get the fill. It's a smaller window. And I typically recommend experienced traders go to shorter term time frames. Now, a lot of people like shorter term time frames because it's always fascinating to me when I see traders really like a lot of activity. You know, um, I'm going to be, I'm always really frank with you guys. Whenever I see a trader needs a lot of activity, I know two things. And this is going to be 98% of the time. A, they're a losing trader. And B, they're just in it for the rush. They're not in it to be great traders. The great traders out there, and there are very few exceptions. I can think of two. One had a chapter written in a Jack Schwager book about him. He's an exception. And another one is one that I personally know. And that's it. Most traders do not do well with a very active approach. They're junkies. They're looking for the next adrenaline hit. All right. And there was a great documentary I just watched on Netflix called Don't Crack Under Pressure. Even those guys are very methodical about their adrenaline addictions, So understand if you're craving more action, why you're looking for it out of the market. And this is very much attached to the daily time frame narrative I'm talking about. If for a lot of traders, what happens with the daily, and this is a warning, so you guys know how to deal with this, because I'm really recommending you guys focus on a slower, more methodical, process-based approach, not just to Forex, but to everything you trade. All right? Don't be so twitchy. If you're being twitchy, find out why. What is it that you're trying to satisfy in terms of the adrenaline boost out of the market? And two, be okay with a patient, inactive style. You know who's a perfect example of this? Warren Buffett. I'm not saying he's a trader. He's not. You can say the same thing about Stan Druckenmiller, who is the greatest trader of all time. They're very inactive in their approach. They're inactive, inactive, right? And then all of a sudden, when all the things line up, boom, they attack. And you'll see the activity level increase. Up until then, they're waiting for their pitch, which is why I love a baseball hitter analogy to trading, which again is all Warren Buffett. He's a huge Ted Williams fan. And it's about waiting for your pitch. I have to mention this if we're going to talk about daily time frames, because a lot of traders simply don't have the patience to do it. And if you understand why you lack the patience, you'll be able to address those issues. All right. So I hope that helps. That's a lot about the psychology of trading. And I find new traders tend to like that action. They love the action. And I will bet dollars to donuts most of the time. They don't have positive P&Ls. And I want you to have a positive P&L. I want you to grow your account. So what are we going to do? We're going to very almost glacially look for the same types of trades we've been talking about now for a couple of episodes here, which is look for Australian dollar, look for New Zealand dollar longs. Last episode, we talked about, in many ways, not supplanting the Australian dollar, but rather letting the New Zealand dollar take a little bit more of the spotlight, where yes, I'm still willing to buy Aussie pullbacks, mostly against the pound, the Canadian dollar, even the Japanese yen. Why those currencies? Well, the pound's been weak, so let's just go with that. It's been a relative underperformer, or it's been one of the best weak stocks. You could be a best weak stock. If you're heading lower with clarity, it's a gift. It doesn't have to be higher. It can be lower too. So we've been looking for Australian dollar buys, New Zealand dollar buys, Canadian dollar shorts, and Japanese yen shorts. Now, why are those two markets moving lower? I think for a lot of traders, it might be a little peculiar that the Canadian dollar is moving lower because the crude oil market's been moving higher, which really just goes to show, please don't ever limit a doll to its commodity personality. It's one of two personalities that it actually has. Right? One is this obvious influence from the central bank. The other is the influence from the underlying commodity, if it's a commodity dollar, known as a doll. The yen's weakness is pretty simple. The markets are in rocket mode. So that's actually a really great segue into Sandy's question about the currency equity connection. All right, so hey there, Deborah, great to see you. How do I handle a depressing time? Well, Suresh, a depressing time is going to be one of two things. First of all, I mean, I'm going to just extrapolate that depressing means you're just either not getting opportunities or you're losing. So I believe opportunities and losing trades have to do with the quality of the trend. We're always going to come back to the trend, always. So if the quality of the trend is low and or the volatility is high, and it's amazing how those two things move parallel, you're probably going to have a difficult time placing an accurate stop. You probably will not have a difficult time getting an entry, but you will definitely have a difficult time getting a stop placed in the market in such a way that it makes sense and you can follow it. Because what happens in choppy, low quality trends is that the price action becomes unpredictable. And that unpredictability, and I'm going to use a measuring stick of historical volatility, that unpredictability becomes the problem. All right. So how do we avoid that problem? High quality trends that are respecting the 34 EMA wave, which is the 34 period exponential moving average on the high, close, and low. All right. So I hope that helps. It's really about market structure. I mean, obviously the mental toll and the disappointment of a negative P&L, I get it. But tactically, and if we're going to think about a way to tackle the issue, you're going to find either you're trading too short a time frame, or the structure of the trends are not high. They're not good. They're not high quality. All right, hang on one second. All right. Okay, so terrific question, and I'm sure you're not alone in that. Hey there, Oren. Great to see you. Great to see you. All right, let's see. Renko, I'm not familiar with him, but I'm always interested in learning and meeting other traders. Okay, that's good to know. Read the book? Oh, very cool, Dee Dee. I'll tell you, those books are, when were those books written? Now I'm curious. I always forget when I wrote those books. It feels like a lifetime ago. Let me go on Amazon here. So first of all, thank you for reading the book. Second of all, those of you that are wondering, do I need to run out and get the book? That's just the last one that I wrote. It's probably the one that I like the best. But let me see here. When was this written? This was the last one. This was written in, just to give you an idea of how much even my personal trading has evolved. And 2010. The thing I like about this one is that it's when I started to really introduce historical volatility models and trading. I really started to get a lot further into, why you need to understand, like, for example, why you need to understand, I'm trying to find a good page here with a historical volatility, but why you need to understand how the market typically moves this is like, for example, that's a graph of the price movement by hour of day on the pound US. And by the way, up until recently, that's all been things that hedge funds knew and used. Maybe not something as short term as an hourly price movement range, but they understood historical volatility. They set their value at risk, their VAR, on those numbers, which is why you'll always hear when the volatility of a market increases, hedge funds have problems, banks have problems, because their risk parameters are based on things doing what they've always sort of done. And when they deviate from that, the algos basically implode. So we don't use it for value at risk calculations, but we use it for, we use it for stop losses, profit targets, understanding whether or not the volatility that we're trading is within historical norms, thereby making our stop losses, kind of going back to Suresh's question, thereby making our stop losses and our profit targets much more accurate and much more predictable. Predictability comes, yes, with trends to a certain degree, but they come with trends that are working within their typical historical price movement ranges. All right. So I appreciate that, Dee Dee. Yeah, that's the last one that I wrote. Probably my favorite because it does sort of embody what I sought to do with my trading life at that time, going into 2010, a decade ago. It's hard to even imagine. A decade ago, and that was, can I be done in an hour a day? That wasn't any kind of shtick. I really wanted to be done in an hour a day. My day trading in futures is typically done in about 90 to 120 minutes. I like to day trade about 2 hours a day, and I like to set up my Forex trades in about an hour a day. I don't want to be in front of the computer all day. I don't want to be day trading for 3 and 4 hours straight. I don't think you really can at a high level. It's too much. I don't think most people can do that. So why set yourself up for failure? Attention and discipline is a finite thing. I think behavioral science has proven that that is not unlimited. We can tone that muscle, but it is a limited thing. So, all right, we're kind of going on some. Is it on Audible? And so this is what I wanted to follow that up with. Again, my most recent Forex analysis, my most recent take and use of those historical price movement ranges that I had introduced back in 2010. My gosh, I was actually using them in 2007, 8, but the book came out in 2010. So my most recent approach to the market, the one that reflects what I'm doing now, not a decade ago, is over at simplertrading.com/Forex. That's my most current approach. And it's actually less charts than ever before and a lot more of that kind of stuff, a lot more of historical price movement ranges and understanding contrast, which is what we talk about almost every one of these episodes. It's really evolved to, as I mentioned, we always want to be distilling, right? It's less about the secret squiggles and price action. It's more about historical price movement ranges and currency contrasts, which also then embody a lot of the central bank policy contrasts and actions. So it's to me, the best version of who I am as a Forex trader right now. All right. So, hey there, Chenille. I appreciate that. I have my moments like everybody else. All right. So let me get to Sandy's question. And sorry for the tangents here, but so Sandy wanted to know what's the connection between equities and currencies. And it's pretty simple. It's the connection every market has. It's not singling out currencies and equities or futures and currencies. It's all about flow. It's all about where people want to put their money. Now, the currency equity connection is far higher, far more connective. That cable connectedness is bigger when we have better, wider interest rate differentials between the central banks, meaning historically, the Australian Central Bank, the RBA, and the New Zealand Central Bank, the RBNZ, they have typically had higher central bank rates, while you have, say, Bank of Japan, the yen, with the lowest central bank rate. And that then creates an opportunity called the carry. The carry is not a trade, even though it's called a carry trade. What it really is a position that's able to capitalize on the percentage difference between two central bank rates. And you might say, well, Rag, it's almost nothing now, and you're right. But if you go back within the last decade, sometimes that chasm is over 6 and 7%. Imagine being able to hold an Aussie yen long position, especially within an uptrend. And not only are you gaining on the underlying trade of being long Aussie, short yen, but now you're making 7% on that position. You're thinking, that's a heck of a trade. At scale, it's a heck of a trade. Now you know why it's been the darling of hedge funds and institutions. But when those central bank rates narrow, when the RBNZ, RBA, and the BOJ, when their central bank rates are much narrower like they are now, that carry trade really is a moot point. However, traders have always assumed that Aussie yen climbing is a bullish thing for stocks, and generally it is. But when that carry trade is really not as viable or as active because the central bank rates are narrower, then it's not really going to be as powerful. But there is a connection, no doubt. So we go back to flow. If I think I can make a good return being long Aussie or New Zealand dollar and short yen, that's where my capital will go. If the only place to get alpha, as it's known, return, is by buying stocks, and these central banks are so low, why would I own currencies? Why would I funnel my capital to this place where the return is very low, if not non-existent? So we go to where we see the returns. We chase, look, even institutions will chase momentum. They call it sector rotation, but they'll still chase momentum. When they're window dressing, when we're seeing a lot of activity, they just do it at scale. But there's still a lot of alpha chasing out there going on. This idea that certain people know things we don't, as a general rule, I have found throughout my career, is wrong. It's just wrong. So let's see. Deborah, yeah, I wrote 3 of them. I got a 3-book deal back in 2006, 16 years ago. No, 14 years ago. And, well, the deal came before the books were published. I think the first book was published in, oh gosh, I can't even remember anymore. Anyway, yeah, I wrote some books. I was a pretty young trader at that point when it comes to Forex. And I'd probably at that point been trading Forex because it's only been available in the US since late 99, 2000. Been trading about 5 to 6 years, I think, when the first book came out. Yeah, so I look forward to writing another one. I don't know that it's going to be on Forex. I think right now, the best version of everything that I do and I think is useful in Forex is in my Forex Freedom class, which is simplertrading.com/Forex. That's the best and most recent distillation of what I'm doing. So I'm really proud of that. So unless I can turn that into a book somehow, I think my next book's going to be on a different topic. New frontier. We'll see. We'll see. So I hope, Sandy, I hope that helped in terms of conversation about equities and currencies. You need to keep some notes. You need to keep an eye on the contrasts of the different currencies. And you need to have, in my mind, again, could you eventually get to the point where you're going to be day trading currencies? Of course. And you're going to use the same tactics, contrasts, etc. But keep your pace a little slower. Give yourself time to make decisions. Look at that 480 or daily time frame and be patient. Okay, be patient. I see a lot of traders want the action, and it's sad. It saddens me every time because I realize that is not a path. It's a path for very few to success. It's an adrenaline junkie, type of approach, which does not grow an account. So start slow and then shorten the time frame as you get more experience. All right, gang, hope that helps. Thanks as always for joining me for these weekly episodes of Forex Fridays. I love doing them. Love being able to talk with y'all. Keep the questions coming. Am I still long Aussie yen? Michael, absolutely. We're adding New Zealand dollar yen, Aussie Canada, New Zealand dollar Canada to the mix. So absolutely. And if I get, kind of going back to our equities conversation, Michael, if we see a meltdown in the equities markets anytime soon, I will look to put that trade on all over again, because if we get a meltdown in equities, we'll see the Aussie weaken, we'll see the yen strengthen for a short period of time. That's when we want to take advantage of that correction and get long on the daily once more. Okay. All right. So everyone have a terrific weekend, and I will see you next week. All right. Be good to each other.